Good morning, everyone. I see a bunch of you logging in right now, but we're going to go ahead and get started. Good morning. Thank you for joining us. My name is Ashley Brown, and on behalf of KLR, I'd like to welcome you all to our third webinar now in our CARES Act series, PPP loans, new rules and forgiveness calculation review. So as I'm sure many of you know, Anthony and Mike have been following each and every update on the CARES Act and now the Paycheck Protection Program Flexibility Act of 2020 really closely. They're going to be doing a quick refresher on forgiveness and the FAQs that have recently been answered. New changes came out overnight, so they'll be addressing those as well. Then they will be taking a deep dive into the loan forgiveness application and walking you through how to fill this out and other best practices before we get to your questions. We just wanted to remind you that a link to a recording of today's session will be sent out via email after this afternoon. And without further ado, I'm going to hand it over to Mike and Anthony.
Thank you, Ashley, and thank you for all that you have done yet again to make another webinar a reality. As Ashley mentioned, this is our third webinar in this series. Our first webinar was April 2nd, follow-on one was April 21st. They've been cataloged on our website at conlitwin.com, and as we can see by today's attendee count, the interest in the CARES Act and the follow-on guidance is still really strong. So just want to thank everybody in advance for the time and attention. And while it's top of mind, on behalf of KLR and our entire team, I want to thank everyone who's a client for being a client. I want to thank all our referral sources and fans and friends of the firm for all that you do. Many of you on the webinar know Mike and I personally from working with us through the firm or in the community. And through these webinars, we've spoken with many more of you and through answering questions, and it's been really great, and we're humbled by the trust you've placed in us, and we look forward to continuing to navigate this unprecedented economic crisis and return to normalcy. Additionally, I would mention that as always, we at KLR are actively looking for new clients and opportunities, so please consider us when possible. So today's session looks entirely different than what we planned for a couple of weeks ago. And I'd like to thank Congress for that. This has been like putting a plane together as you're flying it in the air. So when we originally planned this webinar, we were going to walk through the actual forgiveness application and how to maximize forgiveness, because when we scheduled the webinar, many people would be at the end of their 8-week period or approaching the 8-week period. But now, as Mike and I are going to cover, we have a 24-week period. So many of you will not be filling out the forgiveness application for some time. So we kind of tweaked the webinar to go more for things to consider, items to note, what the current rules are, where we see the rules going in certain cases, so items to make you aware of. And we just want to answer the questions you don't know to ask yet on how to take advantage of the maximum forgiveness opportunity, as well as run your business in a manner to ensure success. So let's jump into it. So this is our agenda for today. We're going to cover the recently passed Paycheck Protection Program Flexibility Act that passed on June 4th. We'll give you a quick refresher on forgiveness and let you know about a couple new developments. We'll answer some of the frequently asked questions, and I can tell you we got a lot of questions for this webinar. Thank you all for submitting them. We're going to walk through the items you need to know about today in the loan forgiveness application, because we're going to show you where we think items are going to change and what you need to pay attention to. And then we're going to continue to get to some of the questions that we received, as well as some of the ones that Mike and I believe people need to consider now. And I want to welcome back Mike to the webinar series. So let's jump in with something. Before we go any further, you need to consider what is your goal with the PPP money that you received. And this really is going to drive your decisions. we've been hearing from many different people, and everyone's like, well, I want 100% of the loan to be forgiven. And I can tell you that if all you're focused on is loan forgiveness, you're doing yourself a disservice, because what we're seeing in the market is that the credit markets are tightening up. The third and fourth quarter are going to be tough for a lot of businesses. Right now, we're seeing people repurpose their vacation dollars and spend it in the economy, but how long is that going to last? So, we tell everybody, you have to look at, do you want 100% loan forgiveness, or do you want to ensure the long-term success of your business? You need to stretch your dollars to make sure that you can come out on the other side. The other item is that we hear from a lot of people that say, well, I talked to so-and-so and they said they're going to do this, and they said they're going to do that. I'm encouraging everybody, do what is in your best interest. Don't listen to the noise. And also keep in mind, there's a lot of other opportunities within the CARES Act to get creative. Even in the most recent interim rule released late last night, early this morning, the government is reminding you once again that you are signing these documents under penalty of perjury and you can be charged with fraud. So I would tell you that don't try to get creative where there's, where if it's black and white, make sure you're agreeing to what's correct. I would tell everybody that rational business decisions are key here, and I would encourage you to speak with your tax advisors, because there's other opportunities if you have net operating losses, or if you've repurposed your facility to offer additional products. You've got some R&D credits that are possible there. Within the CARES Act, there's another provision that allows, if you've done any major upgrades in the last couple of years to your facilities, you can take bonus depreciation on leasehold improvements and carry back those deductions to prior year's tax returns that you filed. So that's where there's also some creativity. But I'm just encouraging everybody with the PPP, do the right thing, and look to ask yourself, what do I want to get out of this, and come out on the other side a stronger business. What I will tell you to consider is that now with this 24-week period, it's going to overlap your year ends. And you need to understand that means your income tax return that you file for the year ended 2020, you may have to extend it if we don't have information, and Mike's going to talk about some of the reasons why. If you're going to do an audit or financial statements for the bank, you might have some issues where you don't know as of December 31st if your loan's going to be forgiven and at what amount. So these are just items to consider, to start thinking about now, so that you're planning accordingly as you get to year end, so that it's not a surprise that, hey, we need to consider this. So we here have always taken a conservative, common sense approach throughout this crisis, and that's not going to change. So without further delay, I want Mike to talk about the Paycheck Protection Program Flexibility Act of 2020 that recently was passed. And I would let everybody know that this could change in an hour. That's what we've seen throughout this process, is that we're going to tell you what the most recent up-to-date rules are, but it could change in an hour. So Mike, I don't want to take any more time before that the rules potentially change. So please let us know about the Paycheck Protection Program Flexibility Act.
Thank you, Anthony. Good morning, everyone. As Anthony just mentioned, everything's been changing, weekly, daily, and sometimes hourly. As Anthony and Ashley just mentioned last night, the Treasury released an interim rule that addresses changes made by the PPP Flexibility Act that we're about to discuss. The Flexibility Act gives PPP borrowers some much-needed relief and a better opportunity to maximize forgiveness of their PPP loans. So let's discuss some key points of the Flexibility Act, as these changes will have a significant impact on how PPP borrowers utilize PPP funds over the coming months. The biggest change was that the Flexibility Act extended the 8-week forgiveness period to 24 weeks. This change gives PPP borrowers tremendous flexibility in how to use their PPP funds and a better opportunity to maximize forgiveness of their PPP loans, which Anthony will be discussing later on. It is important to note here that borrowers may still elect the original 8-week period. So don't get too concerned if you've already spent the money, you've almost spent all the funds in the 8-week period, or you've spent all the funds. You can still elect an 8-week period and accelerate your forgiveness. But for those of you who haven't spent all the money or who just got the money, there's a lot of planning that needs to go on over the next few weeks on how to try to maximize forgiveness. The next key point here is that it reduced the 75% payroll spending cost to 60%. Most of you are aware that, the interim rules that have recently come out set 75% as the spending level for payroll costs, that you had to spend at least a minimum of 75% on payroll. Now that amount has been lowered to 60%, through this act. The flexibility, another key here is the Flexibility Act also moved the safe harbor exemption to December 31st, 2020. As a refresher, the CARES Act includes a provision that if a borrower's FTE numbers, full-time equivalent numbers, and compensation levels are the same at June 30th as they were on February 15, 2020, then there would be no reductions to the eligible forgiveness amount. As a reminder, you have your eligible amounts paid during your forgiveness period, but those amounts can be reduced if you reduce your headcount, your employee headcount, or your employee compensation levels. However, with this act, it moves that date to December 31st, 2020. So now, in theory, you have 24 weeks to spend your PPP money, which for most borrowers will mean you'll be able to spend almost the entire amount, if not the entire amount. And then you'll have till December 31st, 2020 of this year to get back up to your FTE and compensation levels for your employees as of February 15th. And then you will get full forgiveness on those amounts spent during the 24 weeks. We're still wary of the fine print in this area, but it's something to consider when planning for maximizing forgiveness. Also, the PPP Act created an extension of loan maturity date to 5 years. So for all new loans under the PPP Act, the maturity date for any amounts not forgiven will be 5 years. You'll have 5 years to pay them. If you had a loan that was processed prior to June 5th, then that loan amount, you can request an amendment to that loan to move the extension to 5 years, because currently your loans are at 2 years. There's also some full-time employee equivalent relief inside this act. We're going to talk about that a little more in detail later because there's huge implications there. And next, we want to talk about the payroll tax deferral. So it made a huge change to the payroll tax deferral. If you remember from our first webinar, the payroll tax deferral credit, previously, if you were an entity taking a PPP loan, you could participate in the payroll tax deferral credit, but as soon as you got loan forgiveness, you were no longer eligible for that program. So for a lot of clients, it would only give them possibly 2, maybe 4 months of benefit of the payroll tax deferral credit. So let's talk about what the payroll tax deferral credit is, and right now. The payroll tax deferral credit allows employers and self-employed individuals to defer the payment of the employer side 6.2% payroll tax, Social Security taxes, through the end of the year. So basically, if you were to elect to take advantage of this benefit, you could defer your employer side 6.2% Social Security taxes through December 31st, 2020. And you would have to repay those amounts in 2 installments, 50% at December 31st, 2021, and the remaining 50% on December 31st, 2022. This is essentially an interest-free loan on those amounts for the rest of the year. It's something to consider because now for most businesses, they'll be able to take advantage of it because even though they get forgiveness, they'll be able to take advantage of this program. So we just wanted to make sure you're aware of that because for a lot of businesses out there, this could help with cash flow over the next few months. So now Anthony will take us through a quick refresher on loan forgiveness.
Thanks, Mike. So loan forgiveness, many people are familiar with, and not much has changed, but there have been some substantial items to note. You'll see here that how much will be forgiven and what is taxable. Well, we now know that we have a 24-week period to spend our PPP funds on eligible expenses. And we have to spend at least 60% of those funds on payroll-related costs. So we've been asked over and over again, has there been any changes to the eligible expenses or any additional guidance provided? And we can say that the eligible expenses are the same they were a few weeks ago. A couple other things have been added. Utilities, we know that the staples, electric, gas, water, telephone, internet, but there's this word transportation that keeps showing up, and we'll talk about that in a little bit. Additionally, we've seen some areas where they're saying maybe trash collection or security monitoring will be added. We've seen with rent that it's got to be leased premises as well as personal property, meaning vehicles. So that's definitely been clarified as well. But keep in mind, all of the utilities, the rent that you pay, the interest on certain mortgage indebtedness, those all had to be in effect as of February 15th, 2020. We've been hearing for weeks now that the Treasury and the SBA have another 30 frequently asked questions to release. They still haven't released them, and we think there's additional clarification within those FAQs. One thing that has come out is we know that any amount forgiven under this loan is not taxable as forgiveness of debt income. As of today, the expenses that you pay with the PPP funds are not deductible for tax purposes. We expect, with the bipartisan support in Congress, to see between now and the end of the year some guidance on whether or not you will be able to deduct those expenses for tax purposes as well. So that's something to keep an eye on, because that'll really be the home run here, is if you don't have to record the forgiveness as cancellation of debt income, and at the same point in time, you're allowed to deduct the expenses for tax purposes. So what are eligible payroll costs? And, the thing to keep in mind is now at 24 weeks, hitting that minimum 60% threshold is probably not going to be as big an issue for most businesses. And even spending all of all the money on eligible costs is not going to be as big a hurdle. One thing we'll note is that the exception for the $100,000 annual compensation is still in existence. We're assuming, in the past it was 8 weeks annualized $100,000 compensation was $15,385. We're assuming that $100,000 annual compensation now is going to be extended for 24 weeks, or you'll be allowed to include $46,155 in the 24 weeks that you pay an employee that makes over $100,000 as eligible for forgiveness. So that's something to keep an eye on. We believe that's the intent of the act, getting back to reading through the lines of what it says, but we need additional concrete evidence from the Treasury and the SBA on that. Another question we've been getting over and over is, can I pay people bonuses or hazard pay with the PPP funds? And the answer is yes. Over that 24-week period, you can pay your employees additional compensation, but keep in mind the $100,000 cap is still in place. Also to note, the retirement plan contributions. We get this question a lot, is within eligible payroll costs, it talks about making contributions to a retirement plan. The issue is this, and Mike will talk about the accrual versus cash basis difference later on. With retirement plans, you have to go to your plan document, and if it only allows you to make an annual contribution, you're not going to be able to make that annual contribution within the 24-week period. So I'd encourage everybody to speak with your administrator on your retirement plan to see if you can amend the plan, if you think you're going to be short on hitting the 60% for payroll or utilizing all your PPP money for eligible costs. We're also looking at, if you make your annual contribution, your 2019 annual contribution, if it's not made yet, making it in this 24-week period may make it eligible for forgiveness. But once again, we think with the 24-week period, many people are going to be able to spend the majority of that money on the eligible payroll as well as the rent utilities and interest on mortgage indebtedness, that it will not be as big an issue. But if you think it is, we'd encourage everybody to look at your retirement plan fine print. Okay, so we've been getting these questions a lot in terms of how are those that own the businesses or a Schedule C business owner or a partner in a partnership or a member of an LLC, how are they treated? And the most recent interim final rule on forgiveness provided a lot of clarity, but it also brought on more questions. So within this new interim rule, it talks about an owner-employee, and it introduces this concept. Doesn't give us guidance as to who an owner-employee is. In reading back through all the guidance, we believe when they reference an owner-employee, they mean an owner of an S-Corp, and we believe it's going to be a greater than 20% owner, but it's not defined anywhere. So we would encourage everybody that's an owner of an S-Corp to watch for additional guidance on this rule for clarification. But essentially what it's saying is it's going to limit the amount of payroll that an owner-employee can have subject to forgiveness in the calculation. And this rule came out before the 24 weeks passed. So as you can see, we took right out of the interim rule where it still says 8 weeks, but it essentially says that if you're an owner-employee, your forgiveness for payroll costs is limited to the lower of the $15,385 for the $100,000 calc, or $852, which we believe will be $2,452 of your 2019 compensation. So what we think they're getting at here is that if you were the owner of an S-Corp and you were not on a payroll in 2019, you had zero payroll dollars, and you think that you're going to put yourself on the payroll in 2020 to get forgiveness, you're going to be limited to $0 because you didn't have 2019 compensation. So this is definitely something to look for. It further then kind of then adds in that it's also limiting the employer retirement and healthcare contributions on an owner-employee. So once again, this is something to stay tuned and watch for, because we know we have a lot of owners of S-Corps that are tuned in today. Additionally, Schedule C filers. Unfortunately, your forgiveness calculation is strictly formulaic. It's based upon originally 8/52 of your Schedule C from 2019, line 31 of your Schedule C. So if you did not have a good 2019, your limitation is pretty severe when it comes to forgiveness as it relates to the payroll dollars. If you have employees, you're eligible to use their health care and some of the other costs. But if you don't have employees, you're strictly limited to line 31 of your 2019 Schedule C, and we believe it's going to be 2,450 of that number. Additionally, I encourage everybody who's a partner or a member of an LLC to look at your K-1. General partners are going to be capped at an amount that's calculated off of their K-1 or their Schedule SE from 2019. Essentially, it's your 2019 net earnings minus your Section 179 multiplied by 0.9235. You're capped by that amount. So if your 2019 wasn't a good year and you're an owner-employee, a Schedule C filer, or considered a general partner in a partnership, you may have some limitations on your forgiveness factors. So, Mike and I keep stressing, we believe the eligible cost is not going to be an issue. You're going to have enough eligible costs if you go the 24-week period and you have 60%, covered for payroll. We believe where the issue is going to be is in the secondary tests on how you calculate your full-time equivalent today versus pre-pandemic and the amount of compensation you're paying them, because that's where we think you could spend all your money on eligible costs, but if you don't hit these formulas, you're going to have a limitation on your forgiveness. So just to refresh everybody's knowledge, you have to compare your current full-time equivalency to 2 base periods if you're not a seasonal employer. And those base periods were February 15, 2019 through June 30th, 19, or January 1st, 2020 through February 29, 2020. So when you spend all your payroll dollars and your rent and your utilities and you have this eligible cost, you have to multiply it by a formula. The formula has the numerator is your current full-time equivalency. Your denominator is one of these 2 base periods. But now the question comes up, well, a lot has changed over the last few months. I've tried to offer people their jobs back with the additional $600 benefit. They've turned me down. I fired an employee for cause. I've had employees resign. Do I need to replace them? I've had employees who are doing distance learning for their children. They've asked to have their hours reduced. And what we will tell you is that it is very clear in the rules that have been passed that if any of these 4 scenarios impact you, you will be held harmless. You will not have your quotient impact you for your forgiveness formula. So that's some well-received news. So getting back to the formula, you have the full-time equivalency headcount, and then you have the test 2, which is, are you paying individuals what you were paying them in the first quarter of 2020? Is their compensation consistent? And keeping in mind, originally when we looked at this formula, we were comparing an 8-week period to a quarter, which is 13 weeks, which led to some confusion. Well, now we're comparing a 24-week period to a 13-week quarter. So the things to note, you have to look at these numbers, and if you're on salary, you have to make them annualized. And if you're paying hourly employees, you have to look at what their hourly wage was in the first quarter of 2020 and compare it to today. So this is some slides from our last presentation just to show you, and we've tweaked it now for the 24-week period. You did a loan calculation. Remember, it was based on eligible payroll costs. You've got 10 weeks. So your loan eligible amount was based upon 10 weeks of payroll costs, and doing the formula, we had a loan of $716,667. And then we went through the forgiveness factor where we had to have so much spent on payroll over the 8-week period to make sure that we were over the amount. And at the time, it was 75%. When we went through the calculation, we had only spent 70% on eligible payroll costs. And we had spent about 30% on non-payroll costs. So because we had a limiting factor there, we weren't eligible to get the full forgiveness amount because we hadn't spent enough money on eligible costs. Well, now we don't think that's an issue. We think that you're going to be able to be over the 60% of payroll, and you're going to have enough costs to go to the 2-factor formula. So we've redone the slides to show you that over a 24-week period, we now spend exponentially more money on payroll costs. In fact, we now spent $1 million on payroll costs. Remember that our loan was actually only $700,000 plus. And the 60% on payroll costs is a minimum. So you can spend 100% on payroll costs, provided that you have that limiting factor on those that make $100,000, which we've put in here. You'll see the 46,155. We're assuming that's going to be the case. So because we've spent over the loan amount, we have $1 million in eligible costs, we believe the full loan can be forgiven. Our $700,000 loan can be forgiven. And this is where we're stressing everybody that you need to switch gears now and focus on. So you've got your headcount reduction, and you have to make sure that your monthly average of the full-time equivalency for the 24-week period is going to be greater than one of the two periods, February 15th, 19 through June 30th, 19, or January 1, 20 through February 29th, 20. Because in the case we show here, even though we spent enough money for eligible costs, you'll see that our monthly average of FTEs in the covered period was lower. We only had 25 versus 30, and therefore when we do the factor, we only get 83.33%, which means we multiply our eligible forgiveness expenses by that amount, and now we're only getting forgiveness of $597,222. So even though we spent all our money on eligible costs, this test is reducing our forgiveness. We have a secondary test on the salary reduction, but the way the laws are written is that if you get limited on the first test, they don't want to double dip and hurt you twice, so you may be okay on the salary reduction. So I can't stress enough that, this slide, which we had in our first presentation back on April 2nd, is just as important today. You need to understand what your average number of full-time employees are in the 8-week period, if you choose that period, if you don't elect the 24 weeks, or the 24-week period. And then you need to compare them to one of these options that you have. And now Mike's going to talk about some things that are important to note that are developments in calculating your FTEs and what type of flexibility you have for these two periods.
Thank you, Anthony. So when the PPP loan forgiveness application came out, it answered a lot of our questions. Of course, it gave us more questions than it answered, but it gave us some answers, some of the most frequently asked questions we were getting leading up to the interim rule on forgiveness and the PPP loan forgiveness application. So before we review the PPP loan forgiveness application, we want to go through some of these questions. So the first question was, any flexibility on when my 8 or 24-week period begins? This by far has been the number one question we have gotten since the PPP program has started. As many of you recall, the initial guidance was your 8-week or 24-week covered period started on the date that the loan funds were dispersed to you. And from discussions with many of you, we were advising that, we do believe that they're going to eventually modify this a little bit, taking into account that not everyone's work week pay period starts on a Wednesday. If you got your money on a Wednesday, that there would be some flexibility. Thankfully, they did take a practical approach in giving us an alternative payroll period. Essentially, what it allows you to do is a PPP borrower can delay the start of their 8-week period to the first day of the first payroll period following the date they receive their PPP funds. So this basically gives you a slight delay. So if you got it on a Wednesday and your normal pay period runs, say, Sunday through Saturday, you can delay it to the next Sunday, to start your payroll period. Now, the key here is, though, that alternative payroll period does not count for non-payroll costs. So anything that's a non-payroll cost still starts on the day you got your money. So you might actually have two different time periods when doing the loan application. It's important just not to confuse the two. The next question. This is the one. This is right there with number one. This accrual versus cash. This has mostly been answered, but with the extension from the 8 to 24-week period, it's not as critical when maximizing loan forgiveness. Remember, you got a loan that was worth 2.5 months of your average monthly payroll. And now you're getting essentially 6 months to spend that money. For most businesses, that means that you're going to spend most of that money before you even get to some of the ancillary costs that have been of concern, especially regarding the annual retirement contributions. And just to further note, we still do not have a concrete answer on the annual retirement contributions, But pretty much the guidance so far has been that cash is king, that if you pay cash during that period, it's going to count. So if you're paying, say, rent and arrears during your cover period, it'll count. The key being here is that you can't prepay expenses. So for, talking about payroll costs, any payroll costs that you pay and incur during your cover period is eligible. In fact, this was more important when it was an 8-week period, but in theory, your last week of payroll during the cover period, even though it's paid outside of your cover period, would still be eligible for inclusion for forgiveness as long as you pay it by the next regularly scheduled pay date. The same goes with non-payroll costs. So if you have a utility bill, so you have the month of July's electricity bill, and your 8-week period ends in July, but you don't get that bill till August, and you pay it in August at its regularly paid date, it'll still be eligible for inclusion, and they do allow proration. But the key here to remember is you can't prepay expenses. You can't, try to pay 6 months of rent, to maximize forgiveness. But once again, due to the 24-week period, it will not be as important. So earlier we talked about the full-time equivalent, and one of the things that was answered here was, the major question from the very beginning, what is full-time equivalent? What is the definition? Previously, the only definition that was in the legislation was from the Affordable Care Act, which basically said 30 hours. Well, the loan forgiveness application actually gave us a definition of 40, rounded to the nearest 10th. For those of you who read the nearest rule, they actually rounded to the nearest hundredth, so it's they're kind of being inconsistent with their own documentation. Each employee is limited to a value of 1. So if you have an employee who works more than 40 hours and works, say, 60 hours a week, they're not a 1.2 or 1. They're not going to go above 1. So every employee is limited to a value of 1. The key here, though, is that they allowed an alternative method, and we're going to explain on the next slide why this is so key. But borrowers can elect to assign each employee who regularly works 40 hours or more a value of 1, and for any employee who regularly works less than 40 hours, a value of 0.5. This is key because the alternative FTE method is, can essentially negate the effect of a reduction in hours of part-time employees. So for my example here, say you have an employee who works 30 hours a week. That employee would be a 0.8 for baseline FTE purposes. During the 8 or 24-week period, that employee only works 10 hours a week. So that employee would count as a 0.3 during the covered period. Under the regular method, that's a 0.5 reduction in your full-time equivalent workforce. Whereas on the alternative method, there is no decrease. You don't have negative effects for reducing the hours of an hourly employee. There is a question here, though, that I will point out. When it comes to reductions, the reason why we say for most salary reduction, for hourly wage reductions, it's not applicable, is the rules in the loan forgiveness application is pretty much designed saying that as long as an hourly worker's hourly wage did not decrease more than 25%, you have no reduction in your forgiveness formula. And basically, they're saying that because they go by hourly wage and not your total wages paid to them, based upon the fact that you're already getting a reduction in the FTE reduction area. They don't want to hit you twice with it. So the question being is, though, if you take the alternative method, and so you had no reduction up above, do you still have a reduction down in the salary area below? We don't have an answer to that. We've been trying to get an answer, but assuming that you can use the alternative method and have no negative effect, almost all PPP borrowers out there will be wanting to take advantage of the alternative method. And then clarification from the Flexibility Act. I mentioned earlier that the FTE reduction gave PPP borrowers some safe harbors. One, an inability to rehire individuals who are employees as of 2/15/20. This has been a common conversation with a lot of our clients, and the fact that, well, I laid off employees and they got other jobs, and I can't hire them back. So now those will not count negatively against you. Also, too, an inability to hire similarly qualified employees on or before December 31st, 2020. It's a tough job market out there. Trying to find people to replace the people you lost, it's tough. This gives you the ability to document that, I couldn't find somebody to replace them. Now, we don't know the rules related to this, so we don't know the fine print, but they are giving you some outs so that you can eliminate the FTE reduction when doing your forgiveness formula. The third part of this is key. This is for a lot of our hospitality industry clients out there, who work in restaurants, hotels, anywhere where there's a client service. Essentially, in plain English, if a borrower cannot return to previous staffing levels due to COVID-19 health and safety restrictions, a borrower will not be penalized for not returning to pre-COVID-19 employment levels. So basically, if CDC guidelines say you can only have so many, workers in the kitchen, or so many workers on your, so wait staff floor or at the front desk or whatever, if you've got restrictions from a health and safety standpoint, you'll be able to document those restrictions and be held harmless for the reduction in your full-time equivalent numbers. They're basically trying to give you some understanding that, yeah, we understand you can't hire everybody back, unfortunately. That's the key. That's the key there. And then the salary hourly wage reduction. So Anthony touched upon this, that they've gone to an annualized. So you basically look at an employee's annual pay prior to COVID-19 and their annual pay during the cover period. There was some clarification of that because it wasn't very well written section of the act, so there was some major questions regarding that. And Anthony's going to now talk about the loan forgiveness application.
Thanks, Mike. So this loan forgiveness application came out based on 8 weeks. We know that now it's going to be 24 weeks. The government has further said that they're going to release a new loan forgiveness application. We believe this new application will be very similar to the one they've already put out because there's a lot of work put into this. So we're going to highlight some of the items to be aware of. So if you look at the actual forgiveness application front page, a couple items that jump off the screen at us. They're asking for the loan disbursement date, which this is important because, this tells you when your 24-week period begins, but then you can check the alternative payroll period that Mike discussed. You'll have to put that in there. Also important to note, they ask about the employees at the time of loan application. We've received countless inquiries from individuals and businesses that said, hey, when we did that application way back when, we had no idea what the rules were. We put different numbers on there. We put the 2019 average FTEs or the number of employees as of a certain date. We believe the fact that they're asking for the employees at the time of the loan application means now that they've got some clarity on what that means. You can put the real number in there to establish your baseline that you were eligible for the loan. And then they're asking about employees at the time of forgiveness. They're also asking if you've got an economic injury disaster loan, because if you received an advance and it was that up to that $10,000 advance, that will come off your forgiveness factor. I would, if I could put flashing lights around the very item at the bottom of the screen, although you're telling the reader of the forgiveness application what your PPP loan amount was, if your loan's over $2 million, you have to check this box here. The government has come out and said that they will be reviewing loans over $2 million. So very important, if your loan's over $2 million, you have to make sure you've done everything possible to cross your T's and dot your I's and have support, because it will get looked at. Application Part 2 page, very similar to what we've been showing all along, but as we've said, you look at the top of the page now, we don't think hitting the eligible cost is going to be the issue. We think it's going to be the two tests in terms of hitting your full-time equivalency and the compensation restoration levels. Just showing you the worksheet here, why this is important. The government is bifurcating your employees that make over $100,000 and those that make under $100,000. So we think, once again, that's important to note that you're probably going to be limited on those that make over $100,000 to 24 weeks annualized at that $46,000 number. Okay. This is really the slide we want to focus on. There's these safe harbor calculations that can be done. And this is why we decided to kind of scrap going through the whole loan forgiveness formula. So essentially what this says is, if you restore your full-time equivalency employee number to pre-pandemic levels on December 31st, you get a safe harbor where you don't even have to calculate these FTE formulas and be subject to a reduction in your loan through those factors. Why we think that's an issue is that the 24-week period is going to end long before December 31st. So essentially what they're saying is even if you keep your employees through, say, October 31st, November when your PPP loan runs out, and then you lay them off, if you rehire them on December 30th and your employee count on December 31st is higher than it was pre-pandemic levels, you're eligible for a safe harbor formula where you won't be subject to reduction. So it just seems kind of like an academic exercise where if you just hired a bunch of employees the day before December 31st, you'd be able to assure yourself forgiveness. And we just don't think that's the case. And as you can see here, this is the application the way it was written. Step 4 actually says June 30th. We think it's going to eventually be December 31st. So there's these safe harbors to be aware of. That's what we want you to take away, in that if you have certain employee count as of a certain date, all the calculations as to if you have enough FTEs may not even matter. And now the same thing holds true for the salary. If you look at the salary reduction formula, it essentially says what did you pay people in the first quarter of 2020, and if you're paying them at least 75% of that and you restore salary levels, you're okay. Same thing. If your salaries are higher on December 31st than they were in that first quarter, that safe harbor provision would kick in. So if you're giving individuals raises and they're kicking in January 1st, and let's say you just have them kick in a week before, you're going to be over the threshold and you hit the safe harbor. Additionally, the hourly wages are calculated kind of strange. It says, whatever your hourly wage paid to an individual in that first quarter of 2020, doesn't matter how much they make overall. It matters what the hourly wage was. So if you look and you were paying somebody $10 in the first quarter of 2020, as long as you're paying them greater than $10 an hour on December 31st, you hit the safe harbor provisions. So, we just want to bring that to everybody's attention because we think there's going to be some opportunity there to eliminate a lot of paperwork if your business hasn't been greatly impacted. And, by December 31st, you're up and running again. So please be aware of that and keep in mind that. I would just also highlight in the application that we get a lot of questions on what documentation am I going to be required to submit. And at the end of the application, on page 10, there's a whole list of what is going to be required, including payroll records, copies of 941s, copies of checks, copy of lender amortizations for the non-payroll mortgages, copies of utility bills. So just the information is there to show you what you're going to need to submit so you can start building your documentation now. And that leads us into something we've been sharing with everybody now since April 2nd. You need to build a due diligence file because even though the SBA says they're going to definitely review loans over $2 million, they have the ability to review any loan, whether it's over $2 million or under $2 million. They're definitely going to look at loans over $2 million. And what they're going to look for is to make sure that you were eligible for the program, to make sure you calculated your loan amount correctly, to make sure you calculated forgiveness correctly. Also, item of note, the SBA has 6 years after the loan is forgiven or repaid in full to potentially look at this. They are telling you to retain your documentation for 6 years. Now, anybody that's had a child knows that you can have a baby and send them off to kindergarten in 6 years. A lot can happen in 6 years. So that's why we're stressing, make sure you have this file of all your documentation. I'm not an attorney, but I also wanted to note that if the SBA comes in and determines that you're ineligible for a loan and the loan cannot be forgiven, there will be an appeal route. They haven't determined what it is yet. But if they seek repayment because they determine that you were not eligible and you pay back the loan, they will waive taking any further enforcement actions, which, I think that just goes to show the rush nature of all this. They understand that there may be some people that it wasn't done in an egregious manner. I had one client say to me, "Hey, I incorrectly calculated my loan amount and I got an extra $50,000. What should I do?" Pay it back. Pay it back immediately when the loan comes due, because if you you calculated incorrectly, that's what the SBA will be looking for. And just some items of note in your file, here's some documentation to have, copies of anything that you've submitted to the bank for your loan. I would tell you to timestamp and date it. Make sure that you have the current guidance as of the date you file anything, because the rules are changing hourly. So the SBA and the Treasury have said you will not be held liable if you apply or for forgiveness of the loan based upon the rules on the date of application. So make sure you have those rules. And we've stressed over and over, have a memo as to why you took out the loan and how you spent the funds. So I want to jump into some questions, and Mike, you want to take the first one?
Sure, Anthony. So some of our unanswered frequently asked questions. What is the fine print on the FTE elimination as of 12/31/2020? I mentioned it earlier. We really need to know, can you really just hire a bunch of employees on December 30th so that you can reach your safe harbor FTE number, and then you would get full forgiveness? It seems counterproductive to the way the act was intended to be. But you don't know, because originally with the original PPP loan forgiveness application, that's essentially what you could do, because they did not give any additional rules on that one. The next question we keep getting is for those of you who've been reviewing the PPP loan forgiveness application, what exactly are transportation costs? Because it's now listed under utilities. The general consensus is that that's referring to fuel for vehicles. If you have like delivery trucks or autos that are listed in the company's name that are used for services for the business, that's what it's referring to as fuel costs. But unfortunately, there is nowhere in an interim rule or in the act where it really says transportation costs. And the closest they came to it was for Schedule C rules, which talked about as a utility expense fuel for vehicles. So that's where everybody is getting that from. But once again, we don't have a clear-cut answer to that question. The next one is, are self-insured payments for health insurance or state unemployment insurance eligible for inclusion as payroll costs? The general consensus is that, they are payments for health insurance, so most people are thinking that it's going to be includable, but there's no concrete evidence. There's nothing I can say to you in an interim rule or in the CARES Act that says your self-insured payments are eligible for inclusion. But the general consensus is that they probably will be, but I'd like something more solid. Hopefully, with the fact that you now have 6 months to spend your loan amount, that this will be less important, because you're going to spend most of this on payroll, which is the number one concrete thing that we know will definitely be eligible for forgiveness. This one, I probably got about 5 emails in my inbox sitting right now from this morning alone. If a borrower spends all the PPP loan proceeds or restores FTE and wage levels to pre-COVID-19 levels, can they apply for forgiveness early? As far as we know right now, we don't believe that's going to be the case. Is that basically you're going to have to wait to either your end of your 8 or 24-week period, and apply. If you're relying on the safe harbor of the December 31st, 2020, it looks like you're going to have to wait all the way until January 2021 to apply for forgiveness. That doesn't mean you can't prepare your application ahead of time, but it seems to be that you're going to have to wait until the end of either the 24-week period or to December 31st, 2020 if you're trying to take advantage of the safe harbor limitation. And then next question. Are semi-monthly payrolls, meaning you pay your employees twice a month, the same as biweekly payrolls, and why does it matter? On the loan forgiveness application, they gave the alternative period for borrowers, but they they said anybody who pays bi-weekly or sooner. So basically, it was only weekly and bi-weekly payrolls are eligible for right now for the alternative payroll period. But for someone who pays on twice a month, they're looking to get that alternative payroll also. It looks like that's not going to be the case, but we don't know. Rent. This is a common question. Does common area maintenance, property taxes, required insurance count as rent, if it's required under the rental agreement? No concrete answer on this area. Right now, it's still just rent. Question number 7 was answered overnight. Can I renegotiate the length of my PPP loan from 2 years to 5 years? Basically, the interim rule that came out overnight says that you can request of your lender to change your maturity date from 2 years to 5 years. I'm sure they don't have the method to do that yet, but that's what's coming up. What is an owner-employee? What do they have to be aware of? I think Anthony wants to answer this question. Anthony?
I think I've already covered it. Stay tuned. We believe it's a greater than 20% owner of an S Corp. And then the last question, how long do I have to apply for forgiveness? In the most recent interim final rule, all it says is that you have up to 10 months. If you have not applied for forgiveness after the 24-week period, 10 months after the 24-week period, your loan is scheduled to kick in and you have to stop making payments. And why that's important, if you go into the rules, if you read what it says that after you submit your forgiveness application to the lender, they have up to 60 days to let you know on the forgiveness application. So once they take their time and analyze everything, they have up to 60 days. Then they have to submit the loan to the SBA to get the funds from the SBA. So that could take a period of time too. So as Mike said, if you wait to the 24-week period and if you're trying to use the safe harbor provisions on December 31st, you may not get acceptance on your loan forgiveness and approval into the March of next year. So plan accordingly. Okay, a couple other questions that have come up. For Schedule K partners, how do we pay ourselves to satisfy the terms of the PPP loan forgiveness? As I've said earlier, you've got to look at your K1 from 2019. It's formulaic. Do vacation, sick, PTO time paid out count towards forgiveness? And the answer is yes, but keep in mind there's the $100,000 cap, as well as certain payments under the Families First Coronavirus Response Act are not eligible. How should we handle voluntary departures? We talked about that earlier. I would just say document, document, document. You cannot be held harmless, but be sure you have good documentation. Mike, you want to jump in on the next 3?
Yeah, sure. So once the initial 8-week period, assuming Congress does not extend, when can we start laying off employees? There's nothing that says you can't start laying off employees once the 8 or 24-week period ends. Again, we'll caution you that if you're planning to take advantage of the safe harbor elimination, you'll need to rehire those employees. I mean, granted, there is some out in the FTE rules, but you are playing a dangerous game when that. So it's just something that you need to take consideration of when doing planning. FTE calculations, we went over that earlier. Rules for independent contractors. Can we really not count our payments for health insurance as part of payroll? Unfortunately, that is true. Basically, they're not allowing you your health insurance payments as part of your payroll for individuals who are Schedule C filers. And then last set of questions. We lease our office space from a separate LLC owned by our firm. We file a tax filing is rent forgivable. It's going to go by the tax return. So if you file it consolidated and the rental income and expense is eliminated in the consolidation, you're not going to be able to apply that to forgiveness. Our premiums paid by the employer for life insurance, accidental death, short-term, long disability is forgivable as health insurance. The general consensus is that these are not considered, eligible for inclusion as payroll costs. But again, with the 24-week period, it's not going to be as problematic. and an app, I counted anyone 30 hours as full-time. Will I be able to resolve this so as not to lose out based on the headcount? As we discussed earlier, your headcount on your application, original loan application, is not relevant to your PPP loan forgiveness application. So if you calculated it differently when you apply for the loan versus the new rules that came out, it's not going to affect you negatively.
So with that, I just want to jump in and give everybody a couple assignments for homework. So keep in mind the payroll tax deferral. You're now eligible for it, even if you took out a PPP loan, so you may want to consider that. You should also speak with your tax advisor if you've got a lot of money you spent in the last couple of years on leasehold improvements, if you've got NOLs, if you've done any change in your business that may be eligible for R&D, because there are some potential opportunities to get some tax dollars back to go back and amend. Also want to remind everybody, make good business decisions. 100% forgiveness is going to be amazing if you can get it, but you got to make good business decisions. It goes back to the old income tax avoidance argument versus profit maximization. You can't have it both ways sometimes. So with that, I just want to, please allow me to say we have an amazing team of advisors at KLR, and including our marketing team, which is headed by June Landry and Ashley Brown. We couldn't do this without them. So we thank them. I'm fortunate to have my co-pilot, Mike Garcia, to navigate these uncharted waters. I know there's a lot of ways you could spend your Thursday morning, and we greatly appreciate all the questions and you spending time with us, including the question on Mike's golf handicap, which is currently going in the wrong direction these days. But I encourage everybody to please visit our website, conluton.com, our Coronavirus Resource Center. We look forward to hearing from you, seeing you at some point soon. Thank you for your time and attention. And if I could quote Dr. Seuss as we walk away, you're off to great places. Today is your day. Your mountain is waiting. So go get on your way and take it away, Ashley.
All right. Thank you both. That was great. And thank you again to everyone for joining us. As Anthony just mentioned, KLR has created a coronavirus resource center, and the link is right here on the contact slide. We're writing articles and we're updating that daily so that you can stay informed on the latest news and developments. We will also be sending out a recording of this session later this afternoon. And we understand that there are a number of uncertainties right now, especially as many of you are preparing to get back to business and reopening. So please feel free to reach out to us if you have any questions. KLR, KLR Wealth, KLR Executive Search, KLR Outsourcing, and Envision Technology Advisors, our sister companies, are all here to help you. Thanks again, and have a great day.